Joining us now is Wilmington Trust Head of Investment Strategy and CNBC contributor Meghan Shue, and Advisors Capital Management Partner JoAnne Feeney. Good morning to you both. Meghan, I'll start with you. I mean, it was an ugly day on Friday for the markets, really just across the board. We're starting to see a little bit of a rebound here for the major averages. How do you position yourself as an investor, given the fact that there are so many uncertainties now around this COVID variant, and the market was arguably already looking pretty expensive, at least parts of it, coming into this?
Yeah, absolutely, Morgan. You're totally right. So we've got clearly a much wider range of possible impacts on the economy over the next 3 months. And I think what that does for equities is it really elevates the equity risk premium and means that investors need to be careful about what they're paying for certain stocks. And Friday's action was certainly exacerbated by low liquidity and a lot of people not at their desks in the post-Thanksgiving holiday. But we saw a lot of reopening type of names move markedly lower. The stay-at-home stocks did well, but maybe not as well as you'd expect because, as you point out, valuations are already quite elevated for a lot of the tech names. And so going forward over the next few weeks, I think probably the volatility is not over. We are certainly more likely to get more negative news about the Omicron variant spreading before we get clarity on what it actually means for the vaccines that we have out there. So investors should be watching hospitalizations because I think that's indicative of what could happen from a policy perspective. And then on the market side of things, credit spreads, which are obviously have elevated quite significantly along with the move lower in equities. If those stay elevated, that could signal more turmoil underneath the surface.
JoAnne, how do you see this market right now, and how are you advising clients to be positioning themselves? I mean, is it an excuse to take money off the table, or are there areas where you think, despite the fact that the major averages are still up double digits percentages for the year, that there are still areas where you can wring some returns out of here right now?
Yeah, I think Friday was a reminder that these risks have not abated. We've been watching for COVID risks all along with inflation risks, and have positioned client portfolios really to be prepared for this sort of volatility because, we don't know enough yet about where this virus is going to go, as Friday really revealed. And we still don't know really what the Omicron variant is going to do. And so what we've done for clients, right, is to make sure they're more long-term focused. We don't think that this is going to fully or even majorly disrupt the recovery in the supply chain. There could be bumps along the road. And that's what we saw, in some of the reaction on Friday. But ultimately, right, for investors to be well positioned longer term, you want to have a bit of both in the portfolio. We do think the recovery continues unless this thing's proved to be really deadly, and the indications right now are not in that direction. And so you want to have some exposure still to recovery and reopening as supply chains and production really starts to come up. So companies like a Williams-Sonoma, a TJ Maxx, and Amazon, for example, but also to stay exposed to those long-term secular technology companies. We think Qualcomm is particularly inexpensive here and has a lot of room for growth with IoT, with 5G, and other applications. And we also think a diversified hardware semiconductor software company like Broadcom is a good place to be. So for investors, I think the danger here is to be too short-term focused. We should all recognize that COVID remains a threat. We don't know exactly how this particular variant is going to play out. But if you hold, some of these secular growth names plus recovery names, and then also remain exposed to the broader economic recovery, for example, through owning banks, insurance companies, and even energy, we think that those really diversify a portfolio well. And as you know, Morgan, right, we use individual stocks to build our client portfolios, and so we can really pick and choose. And while the market overall might look a bit expensive, there's still very attractive valuations opportunities out there.
Shepard Smith here. Thanks for watching CNBC on YouTube.